All right, what's good? So I'm gonna just try to explain trading as the best of my ability, right? So first of all, you see we have a chart. Usually, if you get trading view, your chart is probably going to be on the left hand side. I have mine on the right hand side, but pretty much this vertical axis just shows the price that price is trading at. So the vertical axis is showing how high price is going and how low it's going, right? And then the y axis, the x axis is just pretty much the time interval that price is trading at. And right now, all you guys starting off, you guys should go to New York time. You should go to time down here, time zone. You should configure your charts to New York's time. Understand we have price tools. Of course, you want to understand first of all the basic fundamentals of price action, which are just trends. So a trend pretty much is just a higher high and a higher low. If price is consistently moving, making higher highs and higher lows, it's pretty much in the uptrend, right? Then we have consolidation markets. The consolidation markets are where everything starts at. So down here, this is when the market is moving sideways, and the logic behind this is the market is moving sideways, and institutions are building up orders on both sides before pretty much preparing for its real move. So in this accumulation or range stage of price, it's preparing to now expand, and when now price expands, it's now choosing the direction that it wants to go, whether it's to the upside, like here, or to the downside. Right, but remember, everything starts in the consolidation, and that's when the market is pretty much building up orders, right? So we have our consolidation right here, we have our expansion, and then now another phase would just be like, as a matter of fact, first of all, like I said, we're talking about trends. So the three ways price can move is either it's going to be moving in a back and forth consolidation, right? So it's either going to be moving in back and forth consolidation, and if you can tell in this back and forth consolidation, price isn't choosing a specific direction for it to go in. So price is just moving in a back and forth range. So usually, some people trade these, but usually the rule of thumb is you don't want to be trading in the sideways market because it's just low probability, right? If somebody's skilled, I guess they can trade in this, but for the most part, you don't want to trade in it. Then we have an uptrend. The uptrend is just it's when you break out that consolidation now, and now you're making higher highs and higher lows, higher highs, higher lows, right? Higher highs and higher lows. And usually a rule of thumb is you want to trade with the trend. You don't want to be trading against the trend because the trend is your friend, and you don't want to go against your friend. You don't want to swim against the tide. Like if a tide if a tide is pushing somebody in one direction, it's going to be very hard for that person to swim in the other direction. Why? Because the tide is very strong and the ocean is strong. And if you're already moving in the direction of the tide, now the best thing to be, of course, if your life is in danger, you want to trade against the tide. But I'm just giving you guys just an analogy. But in the market is an ocean and it has its own tides, and your whole goal is to be able to trade as efficient as possible without having too much stress, right? And something that will cause you to have a lot of stress is trading against the trend because you're trading against the overall nature of where the market wants to go. Because at the end of the day, the market does what the market wants to do. The market doesn't move based off of our individual opinions. The market does what it wants and has a mind of its own. And now our goal is to get in tune with the market and its mind and pretty much trade with it so that we can capitalize off of the fluctuations of it, right? So that's really what it is. So we want to trade in line with the market, and we want to look at the market as an ocean, and we want to trade in line with the tides because that's going to offer the least resistance. In trading, we don't want to have too much resistance because we're not doing what we want to do, right? Like let's say in real life, you get stranded on the seas, and now you have to swim for your life. You have to swim for your life to get on shores. It's going to be very hard for you to do that in the ocean with the water literally moving against you, right? But your life is in danger, so you have to find some type of way to swim against the tide so that you can save your life. But guess what? Once you're trading the markets, that you're not trying to do what you want to do in real life. You would have to do what you want to do because you're doing it so you can stay alive. In this trading game, you stay alive by doing what the markets by trading in line with what the market wants to do. Because like I said, the market doesn't do what you want it to do. It does what it wants to do. It does what the algorithm has designed it to do, right? So we want to trade in line with that tide. So if the market's in an uptrend like this, it's making higher highs and higher lows, and it's really strong bullish order flow. We want to trade in line with this order flow right here. We don't want to trade against it, right? If it's in this choppy back and forth consolidation market, we don't want to touch it. We just want to wait for the market to pick its direction. After it does that, now we can trade, right? So that's the first phase, consolidation. That's where everything starts from. And then the market picks a direction. Now it's the uptrend, right? And then now The other way the market can move is a downtrend. So making lower lows and lower highs, lower lows and lower highs, lower lows and lower highs, right? So now the market can be in an uptrend and it can change to a downtrend. So you just have to understand when the market's in an uptrend and understand when the market's in a downtrend. So let's say right here, the market's in an uptrend, and let's say you want to know how the market is not in an uptrend anymore. We're gonna break structure to the downside, right? This is a break of structure right here. So price now, we close below this low. That's why, you know, you want to understand all the basics when it comes to trading. You want to understand candlesticks. You want to understand basic support and resistance. You want to understand simple trends. That's it. And then now, once you understand that, now you can combine them together to now have a nice basic grasp of what the market is doing and why it's doing what it's doing. Right? So cool. The market can be in an uptrend like this, but once we close below this low right here, now it's not an uptrend anymore. It's in a downtrend. And now once the market gets into a downtrend like this, now we want to wait for a good setup, and then we want to trade in line with this downtrend, right? But just for simplicity purposes, like you want to wait until you know for sure the market's in the downtrend. So you want to wait for a lower low and then a lower high to be established, right? So right here, think about it. We have a higher high, we have a higher low, we have a higher high, and we have a higher low right here. We have a higher high, and then boom, what happens? We have a lower low, and then what happens? We have a higher low now. I mean, we have a lower high now. So once we have our lower high and then our higher low established, now we know that the market's now most likely going to transition from a downtrend to an uptrend. But once we get that second lower low and then our second lower high, now it's really confirmed that the market is now not in the uptrend anymore, and it's now in a downtrend, right? But now, talking about price action, we can even go a little bit deeper, right? So now we understand the three ways that price can move, and that's just in a consolidation, an uptrend, or a downtrend, right? But now we can get more. If you already understand that, now we can just get deeper, right? So in the consolidation, the market is building up orders, and this is the phase that has to be in place before any other phase can take place. Consolidation, that's where everything starts from. It's pretty much the market just building up orders. The market just pretty much, what's a good analogy for this? The market just pretty much just building up energy before it can make its move. So it's pretty much charging up in its consolidation phase. So boom, the market is charging up in its accumulation phase. It's a lot of different names you can call it, right? But when we're talking about trends, we could just keep that simple with consolidations, uptrends, and downtrends, right? Another word for this is ranges. The market being in a range in market. But in this right here, now we're talking about the nature and the essence of some of these different conditions. So now, let's say right here. So now the market's in the accumulation phase. So now we're talking about phases of the market, which we could just classify that as market profiles. And the market profile is pretty much a unique set of characteristics that the markets follow. So we have the accumulation, and inside this accumulation, the market is building up orders, right? And ideally, in this phase, before it makes its move, we're gonna have a liquidity sweep. So liquidity sweep is pretty much running out liquidity down here. So running out all the orders that's down here to collect them to pretty much charge the move that the institutions are gonna make. Because you have to keep in mind, all the big moves that's happening, retail isn't doing it. If you guys didn't know that already, it's not me and you that's moving the market. It's not our individual orders. It's the big institutions. It's the hedge funds. It's the banks. It's the people that have pockets deeper than what we could ever imagine. So boom, right here, now we have a liquidity sweep, which is pretty much a sweep below these orders. And now once we have this liquidity sweep, price can now make its move because now orders have been filled. So that's why for all of our trades, the main criteria that has to be in place is the liquidity sweep, because that shows that now the market has now filled the opposite party to now charge the move, the real move it's gonna make. Then boom, now we have our expansion. And in this expansion, that's now the market breaking out of this range. And now since it's breaking out of this range, now it's pretty much charging for its real move. So how do you know when to get in? Now, this pretty much is a breaking structure. And this breaking structure shows an imbalance in the market. This breaking structure shows an imbalance inside the market, right? And a lot of times it's gonna be shown by a fair value gap. The fair value gap is pretty much that 3 candle formation that we talk about all the time. I'm just gonna show you guys an example here. It's a lot of them. It's really a lot. I could choose any of them, right? But this right here, this is a fair value gap. So it pretty much shows that a lot of energy. It pretty much shows that price was moved one way very aggressively, and that shows an imbalance. That's an imbalance between sellers and buyers, and that creates a fair value gap. So once a fair value gap forms, we can assume that the market is trading in another direction. So look, if you see right here, the market was in the uptrend. They're making higher highs, making higher lows, higher highs, higher lows, higher highs, higher lows. And then what happens right here is now the market right here makes a lower low, right here, but that's not enough. We confirm it right here with this break. So we break below this low right here. We break below this low, the body closes below this low, and then we have this big candle forming a fair value gap. So that once that fair value gap is formed, that shows you that there's an imbalance between buyers and sellers. And now that shows you that one direction is stronger than the other direction. So in this scenario, the bears are stronger than the bulls. So boom, the bears are stronger than the bulls here. And now anytime price comes back up to this level right here, that would be now refilling this imbalance. And that's pretty much the setup that we use. We trade once that imbalance starts to get filled, because once the imbalance gets filled, that's pretty much making price efficient, because once this happens, that's a disparity between buyers and sellers. And since that disparity is in place, a lot of times price likes to come up to fill this disparity, making this inefficiency efficient. And then now once that happens, price can now go inside the other direction. That's why I like to call these levels a lot of time support and resistance, right? And these are our real support and resistance levels that we like to use, fair value gaps, highs and lows, right? But yeah, we're not talking about support and resistance right now. We're going to talk about that in a little bit, right? But pretty much once that happens, that breaking structure happens, so that candle closes aggressively above with a fair value gap, that shows that now sellers are now buyers are now taking place over the sellers, or sellers are taking place over the buyers. But in this example, the buyers are taking control over the sellers. So boom. So now this is our expansion phase. So we have our accumulation phase, then we have our expansion phase. And now, after this expansion phase, we're gonna get things called retracements. And retracements are pretty much just like what I just talked about there. Price is going down to pretty much, I just look at it like recharging. So the market comes down to recharge itself, right? Because that's what healthy markets do. The market's just going up, and it's just in a straight line, just like this. And something's probably wrong. Trump probably tweeted something, or maybe some crazy news dropped, but you should be worried if price is just moving in one direction without any type of retracements, right? So I like to look at retracements as just the market just recharging and just being recharged. So boom, retracement, that gives you, and in these retracements, that's a setup I like to use also. It's another market profile where now this gives you an opportunity to get in. So if you couldn't get in down here, our goal a lot of times is to get in on these liquidity sweeps, right? So we like to be like the institutions where, in the smart money, where we actually buy down here where everybody's selling at, because retail, most people, they like to sell when they see the market's going down. They're not trading with any type of logic or any type of smart money structures of looking at the market. So, yeah, so we have our accumulation expansion phase, and we're gonna have retracements. So that's another market profile, and a lot of times we like to get in on these retracements because these retracements give us opportunities to get in. And a lot of times we get into these retracements in form of fair value gaps. Not all the time, sometimes. So right here we can get in, like there's a lot of different ways. Everything is just really depending on your trading style and your specific entry model. Right, so we can get in on the fair value gap, or you might get in on something like a fib retracement, right? So we take this low to this high right here, and then now we have our fib retracement at something called the golden zone. This golden zone is the 0.62 retracement level. Yeah, go P. So now it's that 62% retracement level. We like to call that the golden zone. And now inside this golden zone, a lot of times that acts as just a really good level to pretty much just get in at, and then your stop loss would just be below that low right there. Really, I'm trying to make this smaller. What the fuck? Okay. Alright, I'm not trying to. What's going on, gang? What? Alright, cool. I thought we was 30. Alright, cool. We Gucci. I'm trying to move this to the left a little bit. Pull up. Maybe that doesn't work on here. Okay, as a matter of fact, I know what to do actually. The fuck? That didn't work? That didn't work. That's okay. Yeah, so yeah, a lot of times also, you just add that fib dot right there. Now you add that fib. Oh, fuck. So yeah, we're gonna have a lot of retracements inside of that overall this price leg until we get to a higher time frame key level, until we get to that place where price wants to reverse at, right? So right here So you can either get in on the fair value gap, or you can get in at a fib level, right? I like to use a combination of these different confluences when it comes to price action and just trading. So we like to use that 62% retracement level, and then we like to get use a confirmation entry before we get in, and then stop loss would just be below this one right here, right? So it'll be below this leg right here, and then, but overall, right? You want to always, for every price leg, be cutting everything from a discount to a premium. So in this price leg, you want to cut it in half from a discount to a premium. You want to cut it in half. Discount premium, you cut that joint in half, and then now you have a 50% level. So now anything below this 50% level, if you're buying it, that's high probability and you're getting in at a good price. Everybody always asks, everybody says trading is you want to buy low and sell high, but how do you buy low and how do you sell high? Well, you have to make ranges and you have to cut things down. You have to determine where that thing that you're selling is at a discount. And you have to determine where you're selling, what does a premium look like, and how is it at a premium? And if it is a premium, how are you determining that? And we're determining that by this right here, right? And a lot of times too, we're not gonna get too deep into it right now, right? So boom, you have your retracements. You have a retracement right here again, boom, boom, boom. So right, so we just talked about two phases. So first of all, we have our accumulation phase. We have our accumulation phase right here. 2, we have